Ticker symbol NSSC is currently up around 6% for the past year, and today we'll be looking at a company which has a unique value proposition with good strategy, which may be a troubled growth machine. Why is this? Well, this is because in the past year it has managed to grow its net income by around 46%, but their revenue in the latest quarter was actually lower than expected, and it was lower than their previous quarters. We do have to consider, however, that Q1 is typically their slowest quarter. So today we'll be looking at none other than Napco Security Technologies, a safety company. In their annual report, they state that they're the leading manufacturers of security devices, intrusion communication services, fire alarm systems, and even school safety solutions. So basically they offer security products in all the different areas, such as access control systems, door locking products, intrusion products, fire alarm, and even video surveillance systems. The way they work is that their products are mainly sold to independent distributors, dealers, and installers of security solutions who will then sell it on to the final customers, or even install it in the majority of the cases. By doing this, Napco is able to just worry about only one thing: creating and producing these amazing products. Then the maintenance, installing, distribution, and all those services can be carried out by these external third parties. And the great thing about this company is that the majority of their growth actually came from recurring revenue services. This is basically the services that they offer, which are basically priced as a subscription, meaning that companies who use or actually provide maintenance regarding these products will actually have to pay a recurring monthly or yearly fee all the way back to this company. And these, at the current moment, represented over 40% of their total revenues, and they had over 90% gross margins. This is extremely difficult to find elsewhere, and it's a very nice thing that they're actually focusing on expanding this sort of revenue source. Now moving on to the future growth, they're planning on doing this in two different ways. The first one is to, of course, keep investing in research and development, especially for real-time Internet of Things or other type of solutions which may be commercialized as recurring revenue services. So one thing they have been doing in the past is just focusing a lot for these products that they want to sell as a subscription. And this is great because it not only increases their margins, but it gives this company a lot more predictability than it had in the past. Number two is that they want to expand their school and public safety offerings, and this is because Napco has seen that these institutions have very large allowances and that they want a lot of their spending to actually go into security. So this company should be at the forefront and be one of the largest producers to benefit from this increase in spending. And I know I'm not an expert on the safety topic. However, it's a lot easier when we break down everything into numbers. As we can see over here that they have a return on capital employed of 29%, an interest coverage ratio of 100 times, meaning that they won't have to worry about debt anytime soon. They have a very solid cash conversion of 76%, profit margin of 54%, and a great operating margin of 26%, which is above our threshold of 15%. And over here we can see what we were speaking about. All these figures are trailing 12 months, meaning that it's the sum of the previous 4 quarters. Well, by doing that, we can see that their net income is up around almost 50% year over year, but also that their revenues have grown a lot. And the great thing to see is that both their gross margin and their net margin expanded in 2022 and 2023, and in 2024 they have been able to maintain the levels that they actually reached. And when we look at their efficiency ratios, since these are more closely tied to profits, then these have followed a similar route, with the return on invested capital sitting way above 45%, which is great. And this is even better. When we look at their balance sheet, we can see that yes, their assets have been increasing very rapidly due to their very fast expansion, but their total liabilities have stayed very, very constant. This has improved their current ratio a lot, and they're currently trading at a point where they almost have no leverage. And when we look at their fundamental analysis, this company gets a super solid 7 out of 8 ticks. Starting off with their low liability risk, as they had an interest coverage ratio of over 100 times, they have a very solid balance sheet as we just saw, with their assets being way above their total liabilities, and with them actually being able to pay all their short-term liabilities only with their current assets. And one thing that I love about this company is that they're extremely consistent at generating free cash flows, and they're able to grow these organically, which is great and is actually funneled through their organic revenue growth. And by organic, of course, we mean that they don't depend on mergers or acquisitions in order to improve both their top line or their bottom line. Next, this company has been paying a very solid dividend and they're growing it at a pretty good pace. But the two most important things from this slide, which are the pricing power and their existing moat or competitive advantage, I believe that NSSC has a tick in both these categories. Starting with pricing power, I believe that the change that they want to make in actually improving or increasing the portion that their subscription services accounts out of their total revenue is a very solid one to make, because here they will have a lot more control and a lot more pricing power over their clients, because these clients will already have all the installation, all the products that they need to have, and everything already in place, meaning that they will have high switching costs. Meaning that unless they find something extremely better than what Napco is offering, which I don't think will be an easy task, then it will actually be a lot cheaper for them to actually stay using Napco's subscription services, even if it's a lot more expensive than other competitors. Additionally, regarding security, now their institutions are spending more than ever in this topic. When you know that it's a product and a company that have been working well for a long time with you, it's something that you don't really want to change. And this jumps right straight into their existing moat or competitive advantage. They currently have a super high retention for their existing clients. I believe it was around 90%, meaning that most of the clients that they currently have are very likely to stay with them until the very long term. And this is one of the greatest moats that you can have, because it's basically deteriorating the entry of other competitors into the industry by showing that these customers actually don't need another provider. And this combination, I believe, is what makes this company so attractive. Now, the one thing that I actually did not like about this stock is the way that its shares outstanding are actually increasing over time. In most cases, I would be okay with the shares staying at a consistent level for a long time. However, in this case, from what I have seen, they were actually increasing in number, which is not something great to see. But hey, this company still gets a 7.5 out of 8. Now, these are the dividends that I was talking about. They currently have a 1.29% dividend yield at a 33% payout ratio, meaning that they still have a lot of room to run in order to increase their dividends and to just keep paying them all around. I would, however, have wanted this payout ratio to be even smaller, so they can focus a lot more on actually investing back into their business. This company actually looks like it's trading at a lower price to earnings ratio than it has been trading for the past 3 years, currently trading around 24 times its earnings. And when we look at their free cash flow yield, they currently have a 3.4% yield, compared to the 3% long-term inflation rate. This also deems the company as that it may be at an attractive valuation. However, this is because recently, last year, there was actually a report on a short seller regarding this company where it was attacking its accounting and all its numbers that it was actually publishing. And they did have a scandal regarding this. They were forced to pay a settlement, but in theory they have this sorted out. When we look at the risks and possible challenges, I believe that of course there is a worsening competitive landscape, as every single year there is more money pouring into this space. They will be facing a lot more companies competing for those same clients. There may be possible upcoming regulation changes. I don't think that they will be to deter these kind of companies, but anything regarding public institutions or schools is of course very highly regulated, especially when it comes to the safety standards. And now that there is a new government in office, we will have to see what changes. And finally, this could be affected by any market conditions, any economic downturn or cyclicality risks, which may actually make these institutions have less capital and be able to invest a lot less on these kind of measures. So now, before we move on, please remember that I'm not a financial advisor and this is not financial advice. However, I believe that this company has a strong moat, consistent cash flows, a high return on capital employed, and I believe that it may be a good company. In fact, despite its short-term uncertainty, I believe that in the following weeks I will be covering it and may actually start a small position just to keep good track of it. Now, I do want to give a big shout out to George from our Patreon, who is the one who actually discovered this company and made me do a video regarding this company. But having said that, as always, thank you for watching. This has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.